Hey there, before we get started, just wanted to give you a quick heads up that this show is going on a 2-week summer vacation after this episode. So you'll hear today, and then it will be back on August 12th. There might be a bonus episode here or there, but in the meantime, you can check out my other podcast Workflows, and I'll see you back here on August 12th.
If you're showing sales of over $100,000 or profit of over $60,000, you want to make the election to be an S Corp, because on your Schedule C, the big thing is on your Schedule C, all of that profit, it does not matter if you left that money in the bank. If you never transferred anything to yourself personally and you just worked and you did not do anything, you are taxed on that profit like it all went into your pocket.
That was Rachel Stas, my current accountant and absolute lifesaver. When I first started my business, a web design business where I basically made websites for my friends' parents, I was 14 years old. My income was pretty light and my expenses were even lighter. I didn't even pay for web hosting. I hosted my first few client websites on a web server in my bedroom, but please don't tell my old internet service provider that. But even then, I knew the importance of keeping track of my income and expenses, which I did in an Excel sheet. I always had an interest in accounting. It was a little bit nerdy. I like looking over my books and doing projections and things like that. And I feel like that really served me well. But then I hired Rachel. She made some fantastic changes to my business that ended up saving me money and lowering my tax bill. And while everyone is different, something that Rachel says a lot throughout this episode, I know the advice she gives today will be great for any solopreneur. Look for these top takeaways. Forming an LLC does not provide tax benefits. While incorporation is an important aspect of running a business, you also need to file as the right type of entity, like an S Corp, to help lighten your tax load. You should track all business income and expenses from day one in a spreadsheet or in a separate bank account. Don't rely on memory, or especially don't mix business and personal finances. That's called piercing the corporate veil, and it could spell trouble for you with the IRS and legally. And don't deduct for the sake of deducting. You should be cautious with what you deduct. Some things, like a home office, might offer short-term gains for long-term pain. Finally, I believe that investing time upfront to properly track finances and get professional accounting help pays off in the long run in taxes saved and peace of mind. It was something that I'm glad I did, but wish I had done sooner. And hiring an accountant is something I recommend every business owner do. It's one of those must hires no matter what business you're in. I know you're going to love this episode. Rachel offers fantastic advice. If you want to hear a longer ad-free version of this episode where Rachel and I talk about my business and I ask her specific questions about my books, you can become a member at streamlined.fm/join. You can find all of the show notes for this episode over at streamlined.fm/428. And before we get into the intro and then the interview, I do want to give a quick disclaimer that this episode and anything Rachel or I say should not be taken as personalized financial or legal advice. You should talk to your accountant and or lawyer about your specific situation. Okay, with that, let's get into the intro and then the interview. Welcome to the Streamlined Solopreneur, a show for busy solopreneurs to help you improve your systems and processes so you can build a business while spending your time the way you want. I know you're busy, so let's get started. All right, I am here with Rachel Stas, CPA, owns a tax firm in Fort Worth, Texas, and is my accountant, both personally and for my business. Rachel, so excited to talk to you today. How are you?
I'm doing well. Thanks for having me.
So I just wanted to level set there for the listeners that like Rachel knows her stuff and is accountant to me and many of my friends and former guests of this show. So really excited to talk to you today.
Awesome. I'm happy to help.
Awesome. Okay, so let's start at the beginning, right, with kind of taxes 101. What are maybe some of the mistakes and I guess the audience here are solopreneurs, right? So mostly people running their own business. They probably don't have employees. They're maybe working with contractors. What are some of the mistakes that you usually see with, let's say, solopreneurs and small business owners?
Yeah. One of the first ones I see is when people first start out their business or they're not exactly sure, like, oh, I have this great idea and I'm going to do a business. And so they immediately incorporate and they're like, I'm an LLC, so that's going to help with taxes. An LLC impacts your taxes in no way. By itself. You did nothing. It's beyond giving yourself some liability protection, possibly if you need it, talk to a lawyer on that. So that isn't going to be nearly as helpful as just keeping track of all the expenses and all the income that you're bringing in from the beginning and stuff. So it's like, you've got to keep track of like, okay, well, I'm starting this business. I put $5,000 of my own money in, write it down. I paid for a consult with an accountant, write that down, like write it down or have a separate bank account or something. But all these expenses that you think you're going to remember, like you're not. Like no one does. You're not going to remember the one coffee that you paid for, 2 months ago. And so if you're not keeping track of your expenses and your income on a regular basis, you're losing money because you're definitely missing expenses and like not getting your best result when it comes to a tax return if you qualify to like need to file it as a business. So that's usually the first a couple rounds of they either incorporate too fast or they just don't keep track of like what they need to keep track of from the beginning. Those are my two big ones.
Yeah, that's really good, right? Because I mean, okay, I started freelancing when I was like 14. And so like pretty low stakes, right? When I was making money, like living in my parents' house. But I learned like maybe a couple years in, like I set up like an Excel sheet this was before Google Sheets because I'm very old. An Excel sheet to like keep track of things like that. And so that's really interesting because it is way more fun to do like the shiny, like I'm going to pick a name and incorporate and design a logo. I guess the follow-up point or question I want to ask here is what is like a spreadsheet a good way to do it? Should people set up a separate bank account or is that like too much in the beginning?
Absolutely. A spreadsheet is amazing. Like I have clients and new clients that come in and stuff, they're like, I'm so embarrassed, but like, this is my Excel sheet or my Google sheet that I use. And this is what I'm keeping track of. And I don't know why they're embarrassed because it has everything we need. You need the date that something happened. And stuff. So when you made the money or when you spent the money, like have the date on it because we need to make sure it was in the right year and stuff. And then what it was for. And like, as long as that's there and you're keeping track, that's all we need as accountants and stuff. We can manipulate Excels into the pretty things that to get your financials from. But at the beginning, I would 100% say just having an Excel and writing everything down. But if you are, been part-time or you sort of been doing your business and you're going to this is going to be the real business, absolutely. Get a segregated bank account, credit card, something like that. The IRS doesn't really care if it's a, quote, business account. It has to be segregated. So you don't want to have a bunch of blended, this income is personal income and this is personal expenses and stuff like that. That doesn't really help us. If you were to ever get audited and people are looking at it, if you have a bank statement that says, Office Depot and like all of these things, and I only use this for business and I can prove that all of these expenses are for business and they have that support, then that's typically enough support to get through the audit and it not being a big deal. But if everything's blended, it's not helpful because then well, then how do you know?
This is mind-blowing to me is that the IRS doesn't really care if it's a business account. I guess that's more like the banking institution they want to know, right? Like if you need to maybe delegate multiple cards to other people, or they can upsell you on their business financing stuff, which has been, I think, the main feature of my my business bank account. So,
and really, I mean, no one writes
that.
checks anymore. But if you wrote checks, like you would have to have the business bank account to be able to have the business name on it. And so that's kind of part of it. It wouldn't be a bad idea to have, I mean, anything that has your business name on it does help like support the case. But if you can make it, if all of your revenue for the business is coming through Stripe and all the Stripe payments are hitting this one account, and then it's like pretty standard dues and subscriptions that are like going out, and you can make a case like this is clearly the segregated bank account, like that's not the part where they're going to get hung up on things.
Okay, so that's really interesting. To me, at least. Awesome. Okay, so incorporating as an LLC doesn't help with taxes. The next thing, right? I just wrote the word shoebox up here, maybe to try to give you PTSD, maybe.
Yeah.
But that was mostly like when I hired my first accountant, he was a family friend, and I messed with him by saying like, oh yeah, I have a shoebox full of receipts, and he like turned white, and I'm like, I'm just kidding. But it's nice to know it's nice to know that joke landed the way I thought it would.
100%. Yes. We've all had the shoeboxes.
Yeah, don't keep all of your receipts in a shoebox. Use a spreadsheet.
Well, and I mean, I get that question a lot. What receipts should I keep and stuff? And so if you have your own your segregated bank account, if you have support for those expenses and stuff already, you're probably fine getting rid of the little ones. But if you are going to like Walmart or Target or, some big box store, and you're buying a computer for your business there, but like it could be for personal stuff, and that's a pretty high dollar purchase, it's a good idea to save like those where you can go, oh no, I have the receipt for this one and stuff, because that is where they might like, if they were really going through. Now, the likelihood of audit is like wildly low, just to be clear, like this, operating under the like fear of that forever is not useful. But if you really like, which receipts do I keep? It's the ones that could possibly be, personal versus business, where you wouldn't be able to tell without the detail. But worst case scenario, you're talking about like maybe a 30% like tax burden on it. So it doesn't matter, like, a $5 receipt. Well, like if they disallowed it, then, oh no, you don't get $1.50, of your tax. Mm-hmm. So it's like the dollar amount, what matters to you on top of it. So that's kind of where it's like, okay, save that for you. Your accountant doesn't need to see it. Like if you have your spreadsheet and everything's there, or you have your bank statements and you have that, like you need to save it for you, because if the IRS asks for something, it's up to you to show them, not your accountant.
Gotcha. Okay, so here's a really good example before we move on to our quick sponsor break and then like the next part of the interview. I am a cigar smoker. I will put cigars on my business card when I know I'm going to an event, like a networking event or a conference where I give them out, which I believe we've been filing under meals and entertainment, right?
We've been calling them gifts.
We've been calling them gifts. Okay, good to know. Great. See, this is why I had you. I would have been like meals and entertainment, and then that's like only half write-offable, right? Or half.
Exactly.
I can write off half of it, yeah. Because I also make purchases on my personal card when I'm not giving these cigars out at events, it sounds like I have pretty clear proof of when I would, hey, I buy my personal cigars on this card and my gifts on this card.
Absolutely. And that actually brings up another good point for like support, and that the IRS would want is keeping your calendar and stuff. So if you are buying, the cigars 1 week before you leave, and then you can show on your calendar, this is where I was, at this event, blah, blah, like that helps too. It also helps with your travel expenses, because you can see when that's coming out and like where you're going. And we haven't talked about mileage, but like mileage works that way too. And so, yeah, having your business calendar, downloading it or printing it or whatever, like having it on file and stuff for the previous year is definitely something I would recommend keeping and stuff, because that would add to like just that support as well. But yeah, the gifts, exactly. There are going to be expenses that you do in your personal life and that you can use for business. And it's like keeping that segregated in different cards, wildly helpful.
Awesome. Okay, cool. So this has already been super helpful. Based on what we've talked about, some people might be wondering if they need to hire an accountant anyway, but we're going to get to that right after we have a quick break from our sponsors. This episode is sponsored by Clarity. One of my biggest projects as part of the show's rebrand is to organize the website's content. That's over 400 episodes, and I was doing it using a Google Sheet. And if you're overwhelmed by that statement, you should be. But there's a better way. Wouldn't it be amazing if you could conduct a comprehensive content audit in minutes, identify areas for improvement with ease, and finally ditch the content guesswork? Clarity is your secret weapon. It automatically syncs your WordPress data, merges your Google Analytics information, and pulls insights from Google Search Console. It's your new go-to platform for content auditing. With Clarity, you can uncover hidden gems by easily identifying low-performing posts with broken links, missing alt text, or outdated information. You can track progress by monitoring the impact of your optimization efforts. You can see what content is truly resonating with your audience, and you can replicate your success by identifying your top performers and leveraging those insights to fuel future content creation. Imagine the time you'll save. No more combing through endless posts or building complex spreadsheets. Clarity makes content auditing and optimization a breeze. And as a listener of Streamlined Solopreneur, you can sign up for just $1 your first month with the code SOLO2024. That's $1 for your first month with the code SOLO2024. To set up your account, go to streamlined.fm/clarity. That's streamlined.fm/CLARITI. Thanks so much to Clarity for sponsoring the show. And we're back. Okay, so I teased this a little bit before the break. With everything you've just told us, like, can I just use TurboTax for my taxes and avoid having to pay an accountant however much I'd have to pay them?
Sure. It really depends on, the flat answer is yes. You can do it yourself if you want to. My professional opinion on it is depending on the amount of income that you have coming in, really triggers whether or not you should hire someone. If you just started a project, you're trying it out, you got paid $800, if you get paid more than $400 to $600, officially it's $400, but $600 is when you get it to 99, it would trigger you needing to file a tax return, for that business. You can probably do that one by yourself. Like, that's a pretty low risk, assessment on it. I have only dealt with one audit as being my own boss. I did not do the tax return. It was somebody who did their own tax return on a TurboTax like system, who their husband brought in about $113,000 of income that year. And by the end of it, they were getting like a $25,000 refund, and they had not paid taxes, like estimated taxes. And dealing with that audit, everything you could have done wrong, she did. So they so they saved maybe a couple of grand not paying for an accountant and ended up paying the IRS, $33,000 at the end of the day. It's just not, it's kind of how risk adverse you are. I will say that, okay, again, audit is not, there is not a lot of audit, period. It's about 3% of any tax returns filed. But out of that 3%, if you have a Schedule C, which is where you report your business income after you've, started under your name, under your social, maybe you have your own EIN, but if you just did an LLC, you didn't make any other elections, that's where it is. It's all on your personal return. If you have a Schedule C on your personal return, those are the ones that get audited. Stuff because they know that people squeeze in some personal expenses. And I do have a home office that happens to be half of my house. And it's like, really though, is that exclusive use and stuff? And it's just the tax laws change every single year. On top of like being in charge of your own business, do you really want to be in charge of like what all tax laws have changed every year? And I mean, it took 5 years of schooling for me to know the baseline to get there anyway. So it's really like the time value of money on doing your own tax return. Yeah, you can do it, but if it's taking you 4 hours, how much money are you like losing? Instead of when you could be working on your stuff or just having free time. So it's kind of a balancing act. I do think that the turbo taxes and stuff like that are a little where they kind of can trip people up who don't have the baseline just knowledge of how taxes work or stuff, is that they don't show the force. They very specifically ask questions. So it's like, oh, did you buy any office supplies for the tax year or fixed assets? Those would be like computers and blah, blah, blah. And you're like, oh yeah, I bought a computer. So you put that in. Okay. Well, then you have your office supplies and like, oh, well, that computer, that was office supplies. So you put that in. And by the end of it, you've claimed this computer like 3 times and stuff. Or like the way the woman who ended up getting audited did, like they claimed their mortgage interest like 3 times and stuff. And it's just like, because you're not seeing the whole picture and they were not in the finance industry at all and stuff. And so it's like, I don't blame her for not knowing, but at a certain point it's like, but you like, this was outside your scope. And so recognizing like where your shortcomings are is helpful. The IRS really looks at that form the most because if you show a loss on that and you have W-2 wages and stuff, it increases your refund. And so they know people want to show that loss over and over and over again. For the record, you can only show that loss two out of the last 5 years, or you end up being a hobby. So like, be careful with that kind of attitude because it's definitely a really big red flag.
Yeah, that's some unofficial advice I got when I went out on my own. It was like, you can report a loss for basically 2 years in a row before you create any red flags for your business. And I'm like, all right, good to know. And I mean, this is the truth, right? Like, sure, you can represent yourself in court, but you also need to be familiar with the laws dictating the state or the federal court that you're in, right? So like, it's probably good to hire a lawyer. And we won't talk like real numbers, right? This will be depending on my level and your comfort level. But we'll talk a little bit more specifically in Streamlined Solopreneur Accelerated. So if you want to become a member and get ad-free extended episodes of this and every interview, you can head over to streamline.fm/428. All the show notes will be there, and a link for you to become a member will be there as well. So Rachel and I will continue talking after we sign off here for members only. But I'll say the amount of money I've gotten in refunds, if I'm doing quick math, has always amounted to more than what I have paid you. I'm pretty sure that's true. And I know that it's different for everybody. And I know that like a couple years in a row, we've welcomed new children that have increased our refund. But, if we look at the scoreboard, I've saved hours. I am not worried. I used to be very worried about getting audited. Definitely the best thing I pay for in my business. Like, no joke. So Schedule C is basically how I did it. I think until about a year after I hired you, we talked about arranging my taxes a different way. And like you specifically mentioned that like LLC doesn't help with taxes, but I think we file my taxes as an S Corp.
As an S Corp. Right? So you do have to be incorporated to be an S Corp. So an LLC is a step on the way to having some beneficial tax choices and stuff, but it's the first step. And so if you do an LLC and then you don't do anything else, it didn't do anything. It's just showing up on your Schedule C. After you've started, your business is going and stuff, if you're showing sales of over $100,000 or profit of over $60,000, you want to make the election to be an S Corp. Because on your Schedule C, the big thing is on your Schedule C, all of that profit, it does not matter if you left that money in the bank. If you never transferred anything to yourself personally and you just worked, and you did not do anything, you are taxed on that profit like it all went into your pocket. So that profit is subject to your income tax rate. You can't do anything about that, but it is also subject to self-employment tax. So your Medicare and your Social Security, which you have not had taken out all year long. And so you get one big bill at the end and you don't get to deduct any of it because it's all personal taxes. So that's where that big hit is. So even if you only had a profit of like 10,000, you've got your tax rate of maybe 15%, and then another 15% of Social Security, Medicare. Now you're paying $3,000 in taxes. And it's like harder when it's $100,000 and then you 30,000. If you do the S Corp, you can roll that business off of your Schedule C. Now it's its own tax return. And so that is what causes, it doesn't pay its own tax. It still flows through to you personally. But now that income, that same 10,000 or 100,000 that rolls into you personally is no longer subject to self-employment tax. So you save that like 15%. It sounds amazing. And it is very helpful, but there is a lot of paper pushing that is required with it. The owner is required to have W-2 wages if you are operating at a profit and stuff. So there's a lot of, you have to be like have enough profit to make it worth it. Which is where the 60,000 amount-ish kind of comes in, where it's like, okay, at this point, at least the S Corp will pay for itself and all the paper pushing, but that is like the next step. Absolutely do not do this on TurboTax. You have to hire an accountant when you get to this level. Please, please don't do it on any of the do-it-yourself tax programs.
Yeah, that gets pretty complicated. Yeah. And to inform what we just talked about, right? A lot of the return gains I saw were after we did this, right? Because there's like the idea that like self-employment tax is essentially like double, like getting taxed twice.
Mm-hmm. Sort of. It is the same income being taxed twice. But if it was a W-2 wage and stuff, you would only be paid half of it, because your employer pays the other half, the 7.5%. Gotcha. And so that's where it's like, oh, but you're self-employed, so you're both. And so you're getting the 15% total there.
All the way.
Yeah. And you don't get to deduct there's a sort of a deduction for the employer side, but it's a better deduction if you're in an S Corp. As the employer, you get to deduct some of those taxes that are already coming out and stuff. And you get to deduct paying yourself those W-2 wages and stuff. So that's like nice to be able to use that as an expense.
That's crucial, right?
Yes.
Like when you're doing Schedule C, it's like owners draw or owners pay or whatever. Whereas like as a W-2 employee of my own business, my wage is a business expense.
Yes. And you can use it to even elevate, like you want to contribute to a SEP IRA or something like that. Now you have employee benefits that you get to run through the company and stuff. So it really opens up some of that availability and stuff once you're in the S Corp. But again, if you're bringing in $1,000, $2,000 of income on your business, keep a spreadsheet, file it on your Schedule C. That is not what the IRS is looking for. Like, you're fine.
Another understanding of mine is that, like, when we bought our house, the lender was a little bit worried that I was self-employed. But because I was a W-2 employee of my business, we were able to get a really good loan amount because we were able to demonstrate, hey, I'm like bringing in half of our income, right?
Yes.
Like, so
W-2s are way more stable. They look at that as like, okay, that's stable income. If they're got it together enough to like have W-2 wages, we're not as worried about the other part of the business.
Yeah. And this is something that I saw with, I won't name names, but an acquaintance, we'll say, who had been running their business basically shoebox style, right? for years, making good money, constantly busy, went to buy a house, couldn't get a good loan because they didn't have a good record of like how much money they were making or how much they were paying themselves. And so the bank was like, this is high risk. Like, we don't know what your income actually is.
Yeah, absolutely.
So,
well, and that's also one of those things where you have to weigh what the benefits of like making decisions just for tax purposes. I don't typically recommend like, oh, well, yeah, buy this or, incur this expense just to avoid paying taxes. You're never going to come out ahead on that. Except so if you're buying equipment that you don't actually need, like you're still out the money and it only saved you maybe 20% in tax, like of that cost in taxes. So like, is that a good use of your like funds and stuff? But on top of that, it's like, okay, well, I want to be super aggressive on all the expenses I'm going to take on my tax return so that I don't have to like pay so much tax. Well, okay. But now the bank doesn't see that like, well, you had quite a bit of money though and stuff. And so it ups that risk. So now you're paying more in interest than you would have if you had just shown like the real income. And so it's a real balancing act, but it carries on throughout your entire career when you're self-employed for sure.
Yeah. I mean, this was some advice you gave me pretty early on was, Black Friday sales happen. And I think a lot of business owners are like, hey, I can get the business expense and a whatever 50% discount on this thing. But like you basically said, like, hey, if you were going to buy this, then buy it and expense it, right? But don't just buy it to expense it because even if you get 25% back in taxes, you still paid 75% of that out of your pocket. Okay, so as we wrap up here, I like to ask for actionable advice for the listeners. What can solopreneurs do to help with accounting or help with their taxes? Like, what are the main tips that you would give here?
For sure, either have a spreadsheet where you're keeping track of everything, and with a calendar, that would be excellent too. Or have a segregated bank account, credit card, something. What really can help is if you have a segregated bank account, everything rolled through that, and you don't have your books, you could give your bank statements to an accountant and they could create books based on that. But if there's a lot of blended personal stuff in there, it is impossible. So definitely do that.
I'll just chime in here as like a little bit of a horror story because I do have an Apple Card that is blended. And so the onus is on me now to give Rachel and her team the unblended statement, basically. It took me a while to do that the first time I had to do that. So definitely have segregated accounts and statements.
Well, and it's a pain. I understand why people don't want to go to the bank and do all that stuff because I was opening up a new bank account and it's like, I have all the stuff. I know how to open up a bank account. I help clients do it all the time. And somehow it still takes 2 hours and you're just like, come on. So like, I get it that it's like annoying, but this is something that will definitely save some heartache down the road. So that would be, I think, my first tip for sure. Don't give your accountant a shoebox full of receipts. It will be so expensive. Like, don't do it. You have to find a newbie at that point because like no one at my level now would take they absolutely not. If you are thinking about hiring a CPA or an accountant, of any kind, start now in the summer months or the fall. Do not wait until the spring. They are full. So if you plan ahead so that you can have a couple of options on that. But yeah, and if you're wanting someone who is like a partner with the business and not a partner like they actually have an ownership stake, but actually care about the business or are aware of it, you're going to want to don't go to like a big box tax preparer place because it doesn't matter. That's a walk-up thing. Mm-hmm. And also be a little cautious of those places. Regardless, you're dealing with people who took like a weekend class. They didn't go to school for as long as most of us have. So, especially with Schedule Cs, find a firm. If you're using someone and you're giving them your tax documents, give them everything they need at once. that's really helpful. It's when I've prepared a return, it's almost done, and they're like, oh yeah, I forgot about this whole new bank account or something. And it's like everything changes when that happens, which means everything takes more time and we're redoing things. And it's like, well, now that bill is going to get higher, like, because it's based on the time typically, and complexity. So having all of that there, if you're getting them everything, March 12th, and if you're an S Corp, because that deadline's March 15th, or if you're getting them everything April 12th, like, you don't want them to file on time. You want to have an extension and give them some time. You are not dealing with like your best accountant brain the final weeks of a deadline. So beware of that as well.
Yeah, that's super interesting. I have one follow-up question on that. I know we're like a little bit over time for the main show, but generally like the deadline for companies to get you the W-9s.
W-2s.
Right. W-2s.
And 1099s. You blended them.
1099s. That's the one I'm thinking of. Yeah. W-9 is what I would send out, right?
Agreed.
To like a contractor. Yeah. Okay. The 1099s, right? Like there's a deadline of, let's just say like February 15th. I don't know.
It's supposed to be January 31st.
So could I reasonably give you everything on February 1st and you can, no. Okay.
I would say, I think February 15th is probably when everything that you were going to get on time, you're going to get. So the January 31st deadline for companies to send out W-2s and 1099s and the 1099Ks and all of that, that is basically to get in the mail. And so you're dealing with the mail. And we don't know.
Okay. Yeah.
Depends on what day the 31st falls on. So if you're talking about a Sunday, then it will be the next day, that kind of thing.
Right.
The brokerage account statements, and it's weird, but they can kind of file for extension. So it might be March, before you get some of this stuff. This is where if you found a good accountant, use the same one because they have your prior year stuff. And so like when Joe sends me his stuff, I can look at it and go, okay, yeah, well, we got everything that you had last year. If you haven't changed anything, we're good and stuff. But if you brand new or something like that, you really don't have like that baseline of, oh, well, you're missing this, kind of thing. But that is the benefit also of like having your own accountant that you can kind of go to, that they're looking at that. They should have those policies in place on making sure that they're looking at prior year and that things are aligning.
I was basically told by a former accountant that I look at the 1099s and then I look at, your income in your bank account for the year. And as long as that's higher than the 1099s, I just run with that. That's like a reasonable thing?
Absolutely. So your 1099 is not as vital as your W-2. So like with when we're putting in the W-2, we have to have the EIN, we have to have all the withholdings. There's a bunch, the documents that show withholding, those are really important documents because the IRS is going to want all the support that like you already paid that money in. With the 1099s, what you're doing is it's telling you like, this is how much I paid you this year and stuff. You definitely want to look at them in case, their accounting is off. But the big issue on that is like, if I've been recording, I've been doing your books and I don't have Joe's books in front of me, I'm making up numbers and stuff. But if I show that he made $100,000 in revenue last year, and then he has a 1099 that says that they paid him $150, then it's like, wait, well, the IRS is expecting his return to say 150 at least on it and stuff. So we either need to figure out where we didn't record 50 or they did something wrong and we need them to amend the 1099. So it's a double check to make sure that like it's all in the same spot. That's where a 1099 is. So if you're like, oh, well, this one person hasn't 1099 me and I know they paid me $600 or more, but it's like, 700, that won't hold up your return. As long as you're recording your income, you can still file without that. So don't let that hold you up.
Another reason I have a separate bank account, right? Like anything a client pays me goes into that one bank account.
Exactly.
But yeah, a 1099 is basically a company saying like, hey, we're telling the IRS that we paid you this much because we're writing it off, right? Like that's kind of
100%.
Okay. So like you should report this because they're going to know you got it, right?
Yes.
Awesome. All right, Rachel, this has been amazing. We're going to chat more in the pro show, but if people want to learn more about you, where can they find you?
I'm really boring. So I just have a website, rachelstastax.com. So you can see me and my little bio, and then my awesome team that works for me. They're great. There's even another Joe. So it's all good.
Yes. There isn't. I speak frequently with Joe.
He's the best.
Your whole team, your whole team is great. I feel it's always a little nerve-wracking, right? When like you work with like the main proprietor and then you get passed off to a team, but like
we're all interconnected.
You hire as well as you do taxes, right? Like, so
yes.
Yeah. Awesome. I will include that and everything we talked about in the show notes, which you can find over at streamlined.fm/428. That's 428. You can also become a member. So if you want to hear this podcast ad-free and get longer versions where Rachel and I are going to dive into my business a little bit more and maybe talk about acquisitions if there's time, you can do that too. But Rachel, thanks so much for spending some time with us today.
My pleasure. Thank you so much for having me.
And thank you to our sponsors. Thanks for listening. And until next time, I'll see you out there.